Well, bidding adieu to 2016, so good time as any to get in the big picture for 2017. While year to date, Nikunj, we've managed to gain about almost 1.5% for the Nifty. Mid-caps have made a roaring comeback, or rather gains of 5%. But the picture in the last 2 months, ever since demonetization got announced, is starkly different. You know, we're sitting at negative returns.
Ayesha, 2016 has been a year of twists and turns. It was largely dominated by political upsets. Then demonetization grabbed all the good and the bad headlines. Earnings have not been there. And we started the year 2016 that this could be the breakout year for us. But unfortunately, this year has not been a very fruitful year, even for a long-term investor. So let's talk about the year 2017. What is the way forward? How 2017 will be different from 2016? To discuss all that and much more, we have our three wise men: Vikas Khemani, Edelweiss, Bala of Birla Sun Life, and Nilesh Shah of Kotak AMC. Gentlemen, good evening. Thank you for joining us. 2016 has been a disappointing, terrible, horrible, and a pathetic year. Let's be real about it. If you're a stock market investor, you've not even managed to beat fixed deposit returns.
Yes, the index would not have delivered that kind of return, but stocks have delivered, funds have delivered, and for last 2 years, 2015 and 2016, index hasn't done well. But if you look at mutual fund schemes, small cap, mid cap, large cap, some of the sector schemes, they have still delivered return. So 2017 also will be stock pickers market. If you pick up right stocks, you will still make money. And maybe the driver of stock market will not be earnings, but other factors like interest rates have come down dramatically in India. What will be your 1 year's holding period return of a bank fixed deposit on a post-tax basis? Stocks will fluctuate on a single day by more than that, up as well as down. So the other drivers will probably still be positive for stock market.
I want to get you into the discussion. And, you know, last year we waded through the storm of a Brexit. We've had the Italian referendum. Trump came and won the Oval Office. And then, of course, you've had demonetization as well, the effects of which still playing out. But the fact of the matter is that the index is still clinging on to 8,000. Is that some show of resilience? And if so, what would be the key events which could actually derail the market mood further, or for that matter, even make them post a strong comeback from here?
I think, yes, 2016 has been a disappointing year given in all the events which have happened, and I think we are now starting 2017 with on the back of two bad years. 2015 was a flat year, 2016 is a flat year, and as we get into 2017, still we have lots of uncertainties on the international front, uncertainties on the domestic front. I mean, aftermath of domestic demonetization, staring at GST implementation, budget, and then UP election. So I think, we are in a sort of quite an uncertain period over the next 3 to 6 months. And what happens is in these 3 to 6 months, both on international as well as the domestic front, will determine the course of second half of next financial year and calendar year. And I think, so environment as it looks like that there are lots of uncertainties. Corporate earnings is still sort of elusive, but still we would sort of see a fairly single digit or a little bit, early teens kind of earning growth, and which is not really good enough. And I think we had a great advantage of terms of trade, in terms of oil price coming back, also sort of puts risk of a bit of inflation inching up. So I think there are lots of, right now at a macro level, which was looking very, very positive 2 years ago, are right now kind of in a confusing situation and completely different. And having said that, since we are starting on a backdrop of too bad a year or too flat year, so you can't be extremely negative over the market, and that probably answers the question that why we are still holding at 8,000, because still long term looks good. Still, macro, given the sheer size of the economy,
Because you remind me of the monsoon prediction for last year. 2 bad years, so we should have a good one. So, but maybe not. Equities work perhaps in a different
one can't really. So
Bala, would you agree with Vikas? I mean, would it be domestic factors like the budget, Uttar Pradesh elections and the earnings, or do you think, again, 2017 also will be dictated by global factors and purely what FIIs do?
I think it will be a mix of both, has to be. Also, given the fact that the year 2016, while the market not on a given return, some of the decision that has actually happened during the period of this entire year 2016 we have to again look at it, is it happened for good from the creating a long-term fundamental structure in place in order to deliver consistent return for the economic growth as well as for the corporate that operate in India, as well as the global investor investing in India. If you analyze it from that angle, definitely what has happened in the year 2016 is actually setting up a platform, is basically what we keep saying actually in our own terminology, rising the bar. And every time you have to rise the bar in order to ensure that your long-term sustainable growth actually becomes more real. So therefore, what has happened this year, including the passage of GST bill and discussion that has been going around, and all of them actually will actually get a fundamentals of India is much better. And having said that, from the 2017 point of view, I think this year, if you look at, I think the beginning of the year, between Jan and February and March, the kind of worry that existed in the country, especially in commodity space, unimaginable. I think most of the people suddenly start feeling that commodity prices are collapsing so much, it could lead to actually destruction of value across the global market. And luckily, that got completely reversed. Now we are seeing a stability. And 2017 is one of the largest economy in the world is talking about investing. Though it comes at the cost of fiscal, which is US, is now talking about investment. Therefore, the investment as a concept, I think globally is picking up. Therefore, the impact of that, I think, has to come in the other markets who are also potentially the big beneficiary.
Right.
Like Japan as an economy is again talking about inflation coming back. That essentially means more investment coming back. Therefore, what has the effort that has been going in the global market in the last few years, if they start actually generating higher growth actually for the global economy,
Right.
I think somewhere it has to benefit even emerging economies, especially like India, where there's a lot of things we have to do with the global market. Therefore, maybe domestic economy will take some time, but global economy should also help India to some extent.
Nilesh, a very popular theme for emerging market was central bankers will follow loose monetary policy. More and more money will chase high yields and risky yields, and that will drive liquidity. Now interest rates are moving up, and markets can handle everything, but they cannot handle higher interest rates because that acts like a gravity. So in an environment of high interest rate regime or high rising cost, what will happen to equities?
So the bookish answer is that whenever interest rates have gone up, equity should come down because your valuation should contract. But we have seen different phases of interest rate cycle. So when interest rates are rising because economy is doing very well and it needs to be controlled, in that scenario equity markets can do well. Between 2010 to 2016, globally interest rates were coming down, liquidity was abundant, and we followed a counter-cyclical policy. We kept liquidity tight, we kept interest rates higher to control inflation. Now globally interest rates are moving up and we are in a position to cut interest rates. The gap between American 10-year yield and Indian 10-year yield is still 4%. There was a day when 10-year American yield was 4.5 and Indian 10-year yield was 4.95. At 45 basis point spread, the RBI governor talked about Tobin's tax to control the inflows which were coming in. So 4% is a decent gap. We can still cut interest rates, we can still provide liquidity, provided inflation continues to remain subdued. And after following tight monetary policy for 6 years, between 2010 to 2016, there is hope that inflation will remain subdued. So our interest rate cycle will be a bit different from the global interest rate cycle. As long as we can convince the market that this interest rate reduction will help in reviving economy, will help in reviving capex, will help in reviving consumption by leveraged buying, then I think markets will do well.
In the year ahead, Vikas, last year we've seen the budget low of 6884. From there, we've risen all the way to 8900. And right now at 8000 thereabouts, we're still at the higher end of the range, surprisingly so. Next year, what sort of a market level are we looking at?
Yeah, I think, again, stocks market levels could be sort of difficult to call, but I think if you look at the corporate earnings, 17 is going to be around 10-11%. 18 currently, broad consensus estimates around in the range of 15-16%, but my personal sense is that I think it's all going to get downward if the current pace continues, and you might see some sort of downward revisions, but a lot will depend on what kind of measures get taken and also. But I think still you're talking about 12-15% kind of earnings growth. If that is the sort of broad, you might see similar-ish kind of return getting delivered, because I don't see markets
10 to 15% index returns?
Return could be possible, because I think I don't see markets getting de-rated, but at the same time I think re-rating the market will be difficult given the kind of muted growth and given the kind of still a lot of international headwinds would be there I think dollar strength is going to be a reality. You will see a couple of Fed rates hike happening. So I think flow towards emerging market would be limited. Fortunately, we are in a good situation where we have domestic flows fairly robust, and that will provide some sort of cushion, which has been providing and will continue to provide that kind of situation to the market. So I would say, one should not be very optimistic about the market of 18 to 20% kind of return in this calendar year. I'll be happy if we stay anywhere between 12 to 15% kind of return, given whatever context we have. It might change as we progress into the year, depending on how the policymakers take decisions. But currently, it looks like that we are in that.
Nilesh, are you getting a sense that from a global standpoint, the Modi premium has vanished, the India risk premium has gone higher, the world is worried about policy action or knee-jerk policy comments which are coming from policymakers? If I take the clock back 2014, when Prime Minister Modi got elected, Indian markets, they got re-rated without earnings, P multiple expanded on hope and hype. Now reality is haunting us.
So if we look at the debt investors' behavior, we do see they have sold almost 45,000 crore of debt, and post demonetization pace has picked up. Now, are they withdrawing because they don't like India, because they don't like Prime Minister? My guess is no. India was not part of benchmark index. Our interest rates came down, our currency remained stable. It's almost like, in a large cap fund, you had picked up a small cap and it did very well. From a small position, it has become substantial position of your portfolio. What do? You have to trim it down because it's not part of the benchmark index. So the FII's redemption on the debt side is driven by one, India being not part of the benchmark index, and second, having done very well, people are taking the profit out. Partly it could also be attributable to the fact that US yields have gone up, US high yields are now attractive, so they are booking their profit. On the equity side, year to date FIIs are still up 23,000 crore. Of course, from December, from demonetization they have sold, but that's more related to US yields going up, more related to other emerging markets doing exceptionally well. Some of the markets in emerging market, courtesy the currency movement, have done exceptionally well in dollar terms, and obviously people have to book their profit. So my guess is that it is not that FIIs are worried about India. They are treating India as a higher risk market, but they are clearly waiting and watching over the events. There are multiple events which you mentioned: budget, demonetization, UP election, RBI's liquidity and interest rate cycle, and most important, corporate earnings recovery. As we are today waiting and watching, they are also waiting and watching.
Bala, what is your sense? What could be the big theme which could sort of wade all these storms, whichever way these events are likely to pan out?
I think from an economic point of view is clearly what we have been advocating for the last many number of years, which of course are on the investments and consumption. That need to be the central focus actually for the government. But I think that's
No, I'm talking about investment sectorally. What will wade the storm? Where should investors park their money?
Of course, clearly is an asset class, asset allocations will play a bigger role. And having said that, the two asset classes, which is both fixed income and equity, both asset classes will remain a better asset class compared to any other investment which predominantly Indian investors have been investing, which is mostly in real estate as well as in some other sectors which does not create an economic value, including gold. Therefore, the asset classes both in equity and debt will become.
So you're saying hedge yourself, go through the balanced fund approach.
Correct. So that I think will become one of the asset classes. Second is, having said that, I think one need to also keep in mind, as Nilesh mentioned about, the structurally the interest rate in India is going to stay a longer period at a low level. Given the fact that the complete destruction that is happening in the case of inflation, there is a lot of discipline that has come in the case of fiscal management. Therefore, there is absolutely no reason actually why the interest rate has to go up quite significantly. Therefore, the investors, when they come to a scenario but they have to live with the low interest rate regime both for the borrowing as well as for the deposit they are making. So they need to look at other asset classes which can generate a better return than any of these asset classes. That's why I think equity and fixed income will remain a key focus for the investors at large, even in 2017, even beyond that for that matter.
Okay. Now, because there are two ways markets correct: time-wise and price-wise. We've not seen too much of time-wise correction, at least in mid-cap stocks, but we've seen a decent amount of price-wise correction in some of the mid-cap names. So as of now, where do you think markets are pricing in decent amount of margin of safety, and where do you think price-wise correction or time-wise correction is over?
So I think, if you see wherever we saw sort of bubble getting built where there was reasonably good earnings growth, good quality management. So I think quality had built reasonably good amount of premium, and we have seen significant correction happening in some of those very, very big names.
So would you like to revisit the Asian Paints, the Page Industries, the Nestlés and the Ayeshas of the world, Bajaj Finance?
Absolutely. So in my opinion, there's a time to kind of revisit some of the high quality names where the corporate earnings growth will be still good, and corrections have been very, very significant. Something like Asian Paints has corrected significantly, almost I think 25-30%, and it might happen in the course of, as we see, maybe more. But I think those kind of high quality names, where as and when the earning cycle revive, growth comes back, they will be outperforming the overall market. So I think, in my opinion, those quality names one should definitely keep in mind. And as I agree with Bala that it has to be stock specific, it has to be sector specific, where one has to kind of look at. There are certain companies where significant capex has already happened, it's behind, and now earnings growth is going to come. Some of those names, in my opinion, look very, very good. So I think broadly, and some structural, positive output of things like demonetization, in my opinion, private banks tends to benefit a lot, because I think you will see more money in their, CASA. You will see more transaction happening through the digitalized channel, more credit growth in the private, on the retail side. I think those kind of, sort of companies also have corrected reasonably well in this sort of correction. So I think, sticking to the quality, sticking to those names where corrections happen, margin of safety is getting built, should be looked at through this year.
Now, Nilesh, the word optimism is missing for 2017. We are revisiting.
No, Vikas is the most bullish voice on D Street right now.
Long term.
Really.
But in general, the market narrative is not centered around big economic recovery. I guess what we are discussing and debating is A, protect capital, and B, we are in an uncertain environment both locally and globally. And historically, when that has happened in the past, IT and pharma, they tend to do well. Consumers, they tend to outperform, because markets, they call them as defensives. That definition also is getting challenged. So my question to you is that historical correlations are getting challenged. So in this uncertain patch, what could be the new defensive and what could outperform?
There's a very famous quote by Warren Buffett that if everything was to be learned from history, then librarians would have been the best fund managers. The reality is that history does repeat, and people.
So you're telling don't go to MBA schools?
I am a chartered accountant, so I have my views on against MBAs.
You must be in demand the last 2 months.
My fraternity was in huge demand, but not me. But the point is that, 2016 has been a black swan year. A lot of things which people couldn't expect or predict actually happened. The whole financial market was saying that Brexit will not happen. Brexit happened. The whole, American press and the world press was talking about Hillary Clinton being the ahead in presidential election. Donald Trump emerged as a president-elect.
What are they saying about the Uttar Pradesh elections, Nilesh?
With that credibility,
Let's
I might as well throw I might as well throw the coin. If it's head, X party. If it's tail, Y party. Probably that will have a far better chance of success. But essentially, a lot of events have happened which we could not have predicted. And going forward in 2017 also, there are scenarios which will create market bullishness or which will dampen spirit. So on 29th Feb, we made a bottom of the market, which neither Brexit nor Trump nor demonetization could shake. That was basically Finance Minister's commitment on path of fiscal prudence. He laid a roadmap for 3.5% for FY17 fiscal deficit, 3% for FY18. Now, expectation from market is that you will cut rates to boost consumption, you will spend money to build infrastructure, and you will maintain fiscal deficit. It's not that it's not possible. You plug the tax loopholes and you can actually achieve, that tax collection, which will help in arriving at these three objectives. If he does that impossible thing, markets will take off. But if he doesn't, then markets will have to correct. Similarly, you have liquidity and interest rate cycle. Now, the expectation of market is that liquidity will be abundant. Interest rates will be at the lower level, which can spur consumption, which can spur infrastructure investment. If that happens, markets will take off. If that doesn't happen, then markets will come down. The third thing is UP election. The market is expecting that pro-economic reforms, pro-growth policies can win election. If that happens, markets will take off. If they realize that no, it's farm loan waiver which is going to win elections, then certainly markets will have to correct. Now, these are all binary events. If the outcome comes positive for markets, markets will move. If outcome doesn't come positive, markets will have to make adjustment. So it's more likely to be a pendulum market, and if you have a 1 year horizon, then focus on your timing. If you have a longer term horizon, then stay on the pitch. You will get half volleys, if not in the first half, at least in the second half.
Bala, I would have loved to ask you how he's going to go ahead with the Herculean task of budget and what sort of math we'll figure out. But since we're running short on time, you're betting big on the infra theme, and therefore cement is a favorite sector with you. Tell us why you're bullish on that.
I think the big focus for the country is actually increasing the employment. And there is one sector which can actually increase the employment in the country is the real estate sectors. The real estate sectors at large, given the fact that the housing needs for the large population of the country is still very, very high. And the government focus, which I think brought in last year in terms of making the affordable housing actually is much more lucrative option to drive the economic growth. And that if it comes, then the whole consumption pattern across the ancillary cycle, it's not just only cement, across the ancillary sectors, in and around the low cost housing sectors, has to be the biggest beneficiary. And given the fact that today the interest rates are also it's somewhat at a reasonable level, therefore affordability for the borrowers also is going to be relatively easy. And secondly, the government is also bringing a high level of focus in terms of driving the sectors in order to create the employment in the country. Then naturally all these sectors should actually be one of the biggest beneficiary of that. And that I think seems to be one of the main focus that all of us have been harping upon, and even economic growth also will come once you start focusing on employment growth. As Nilesh mentioned about, there are many things that will keep happening, but I think in terms of growth path, if you're able to lay out very clear direction, what could drive the employment, what could drive actually some of these manufacturing sectors actually the benefit out of those activities, then naturally I think has to result in the economic growth numbers, that has to result in the corporate performance getting better, and it also has to result in better tax collections. Of course, big theme is actually around the GST. I think as you may were able to make it through before 30 September, then the success of GST linked to the demonetization I think is a big lot higher than actually the link to the success of GST without demonetization. I think clearly the whole parallel economy is coming to the main economy. The kind of tax collection that probably the country as a whole can witness, nobody can imagine, nobody can put the number to it. It can be 4 times higher, it can be 5 times higher. I will even take a bet in the year 2017, the number of people who are filing tax return can go up at least about 4 or 5 times. Given the fact that
they don't have a choice anymore.
They don't have a choice anymore. So that actual number, we can always say double, triple, but it can go by multiple number of times. And that actually change of behavior that comes in the Indian consumer eventually actually make the economy more stronger. I think that's what we should hope for in the year 2017.
Nilesh, closing comments from you as well. December 2015, we had written an obituary for metals. Metal index this year has given a 45% return. Right now, some have written an obituary for pharma. The remaining have written an obituary for IT. So 1 year forward, can IT and pharma as a sector really surprise us?
Selectively, yes. Even in 2016, the best performing stock is a pharma company. Of course, it's an isolated case rather than a sectoral case. The worst performing is also from pharma, but you have both the extremes. So if you can pick up select stocks in pharma and IT, I think you will do very well. On the domestic side, we are all living very healthy lifestyle. The stress and pollution does not impact us at all. So our medicine consumption is, going to remain where it is. That's what a person who is not bullish on pharma will believe. We know what the reality is. The second thing on IT, today there are opportunities in front of us. If we can go into spaces like analytics, Internet over Things, cloud computing, security, programming, in terms of product development, gaming. Now these are all the places where we haven't really moved as aggressively as we should have, but it's not something which is beyond us. So valuations are towards you in your favor in IT sector, and if you can pick up companies moving into this space at a faster pace, you will make return in 2017 as well from this sector.
Yeah, maybe have our own version of Pokemon Go or something, right?
You never know. All I'm saying is that if you're an equity investor, you have to remain optimistic. Good news and good prices, they rarely come together. Right now we're discussing what is called a crisis. Like Churchill said, never waste a crisis.
Yeah, indeed. Okay, gentlemen, great speaking with you all, and let's just hope that year 2017 is not of a crisis, but we get those opportunities and make most of them. Here's wishing all our viewers a very happy new year and a prosperous one from all of us here at ET Now.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.